The ongoing question that investors always ask, including myself all the time, is what's the best way to invest our money? Should we lump sum and put everything all in at once, or should we dollar cost average, which is just a fancy way of saying put things into the market gradually? It's one of those age-old questions that's been plaguing humans, like should you put pineapple on pizza, and is a hot dog really just a sandwich? Thankfully, there is a straightforward answer to this question, and there is kind of a best way of doing things, but really a lot of it comes down to you. So I'm going to need you in this video to ask yourself a few different questions, and I'll give you a few different considerations at the end. So in this video, I'm going to look at all the evidence of several different studies to see which way is the best way to invest our money, and I'll give you all the information that you should need. And then finally, I'll give you some considerations that you might want to think about, because it isn't just as simple as you think. Either way, let's get straight into the video. Okay, quick recap. So lump sum investing is putting all of your money into the market in one go. Not looking at the prices, not caring whether the market's at all-time highs. It's just being really disciplined and saying, right, let's YOLO this. On the other hand, dollar cost averaging or pound cost averaging, or whatever you want to call it, is basically putting your money into the market or into a stock over a set period of time. That could be over a number of days, weeks, months, or even years. The reason that investors even ask this question is because we have no idea what's going to happen next. We've got no idea what's going to happen in the future, and we need to work out what's the best way to get maximum returns, especially if we're a long-term investor. As we already know, it's just not possible to time the market. And by that, we mean we don't know when the lows are going to be, we don't know when the highs are going to be, so we can't buy at the absolute bottom, and we've got no idea if we'd sell at the absolute top. So we need to figure out what's the best way moving forward. It's very funny that often people who claim to time the market tend to behave in the very opposite way that they say they do. They often buy all the way on the way up with a fear of missing out, and they sell on the way down out of panic, so they end up losing money in the long run. Anyway, it totally makes sense that we want to reduce our risk when we go into the market, so we want to make sure that we choose the best method possible to make sure that our gains are going to be the biggest they can be. Thankfully, there's plenty of data and plenty of studies that have already been done, so let's jump into them now and have a look what they say. One of the most in-depth studies looking at this subject on the lump sum versus dollar cost average debate was done by Vanguard back in 2012, and they looked at the data of the stock market between 1926 and 2011. They took a lump sum and they took a dollar cost averager, and they pitted them head to head over 10-year rolling periods, which gave them thousands of data points to analyze. The lump sum investor threw all of their money in at once, YOLO, who cares? And the dollar cost averager chose a period of 12 months to finally get all of their money invested, and then left that for the following 10 years. So what were the results, I hear you ask? Their data showed that over those 10-year periods, those rolling 10-year periods, the lump sum investor beat the dollar cost averager around 67% of the time. So around 2/3 of the time, a lump sum investor would beat the dollar cost averager. Funny enough, this data didn't just apply to the US as well. I know you're thinking it's just the S&P 500, isn't it? No, they actually did the same study across the UK and Australia, and guess what? The results are pretty much identical. The data pretty much says that 2/3 of the time, the lump sum investor will beat the dollar cost averager out of their money. But hang on, it's not just that simple. There are a few caveats we've got to discuss. One thing to note here is that although the lump sum investor won most of the time, 2/3 of the time, the amount they won by wasn't really a huge amount. It wasn't exactly like Usain Bolt versus your granddad. It was more just a very small amount and a small difference. And in fact, the lump sum investor beat the dollar cost averager only really by around 2%, which isn't a huge amount of money over a 10-year period. It's certainly nothing to be sniffed at, but it's not going to go change in your life anytime soon. In summary, Vanguard found that on average, an immediate lump sum investment has outperformed systematic implementation strategies across global markets. This conclusion is consistent with finance theory, as immediate investment exposes cash to upward trending markets for a greater period of time. There were a couple of more things that the Vanguard study found as well, and actually, if the longer you left your money outside of the market, the worse you would do. So in this example, the dollar cost averager put their money in over a 12-month period. If they'd left it for a 2-year period or even a 3-year period, surprise, surprise, they do a lot worse. So there's a lesson there. Don't leave your money sat in cash. But wait, there's more data too. Another study. So Northwestern Mutual Fund Management also did a similar study looking at data from around the 1950s to present day, and they found, to be honest, very similar results. Their stock portfolio by lump sum investing beat their dollar cost averager scenario around 75% of the time, probably because since 1950 the market's been a little bit kinder. Their study also found a big difference compared to Vanguard too. So although the lump sum investor beat the dollar cost averager most of the time, they didn't just win by 2%, they won by around 15%, because they chose to go all in stocks. They didn't worry about bonds at all. And here's a final study I wanted to bring to your attention by JP Morgan. Now, this is not an exact comparison of pitting against a dollar cost averager and a lump sum investor. This one's more about that timing the market and having your money outside of the market and how dangerous that can in fact be. They looked at 5,000 different trading days since the year 2000 in the stock market. And funnily enough, there've been lots of very good days and lots of very bad days too. They ran the scenario that said if you had your money out of the market for the 10 best trading days during that 5,000 day period, you'd be losing a huge amount of money. Just wait for this. If the money had just been left and they put that $10,000 in at the start and they left it for the 5,000 trading days, their $10,000 would be worth $32,000. So pretty nice return if you ask me. However, missing those 10 best trading days with their money sat on the side, they would have lost nearly half of that investment. So after those trading days and after the end of that investment period, they'd only ever have $16,000 left. Also, the data just gets worse from here. If you'd missed out the 20 best trading days, then you pretty much just break even. Your $10,000 investment after missing just 20 of the best trading days in the market only ends up being $10,000 again. I don't know about you, but you'd be pretty damn annoyed if that was you. So the lesson here again really reminds us that we can talk about dollar cost averaging a lump sum all we want, but really remember, we need to be invested in the market, and it's much better to be invested in the market than not invested, certainly when we look back on historic data. So what's the best way to invest? This is pretty much a clear conclusion, right? Well, based on data above, certainly, it seems like lump sum investing is the best way to go. It beats out dollar cost averaging 3/4 of the time, 2/3 of the time at worst. So is this the best way to go? Well, technically yes, but this doesn't apply to most people. Now, I don't know about you, but I don't have tens of thousands of pounds sat in my bank account ready to invest. And actually, the way I invest, like a lot of other people, is through my paycheck, and I'll invest every single month what I designate into the stock market, both in the good days and the bad days. And occasionally, yes, outside of that, I'll make the odd investment here or there. So in theory, if you get paid every month and you invest that money into the stock market, does that make you a lump sum investor or a dollar cost averager? Well, that's kind of up for debate, but technically you could argue that you're a lump sum investor by doing that, because technically you're investing all of you have immediately. You don't have anything else left to give. So by doing it this way, you kind of benefit the best of both worlds. You make sure your money's into the market, and you also reduce your price volatility because you make sure that you buy during the highs and also during the lows as well. And if you are lucky enough to find yourself with a lump sum of cash from a windfall or a lottery win or anything like that, sure, lump sum investing will win most of the time, but remember, past performance is not a guarantee of what could happen in the future. So just be aware of that. But hold on, what's the real answer? As with everything, there's a few more caveats we need to think about. It's not cut and dry that lump sum investing is the best way to go. It really depends on you. Lump sum investing absolutely beats dollar cost averaging, but remember these were over long periods of time. These studies took periods like 10 years, for example, so unless you have those investing horizons, it's not so cut and dry. Remember, nobody knows what's going to happen with the market tomorrow, even next year, even the next couple of years, even in the next dozens of years. We hope they'll go up, but we just don't know what the route's going to be. Also, none of this takes into consideration your own risk profile. If putting in all of your money at once scares the life out of you, and I don't blame you at all if this scares you, then it might be better to dollar cost average, because then you're not going to be too worried and too anxious about having all of that money into the market. It's really not all about those final dollar amounts if you're going to feel really, really bad and not sleep very well. Think about this. If you lump summed all of your money in and the market plummeted over the next few months 20 or 30%, and on paper you've just lost 20 to 30% of your entire cash lump sum, you'd be pretty annoyed, and you might be this close to selling out.
Oh my God! Okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm!
It's all about what goes on up here and making sure you can resist and making sure you can take emotions completely out of it. And if you can't, maybe it's best to invest over that longer period of time than throwing your money all in at once. All of the S&P 500, for example. But what if you buy individual stocks? Well, it doesn't really necessarily work like that. There's plenty of companies who you could dollar cost average in, but they could quite easily go bust. So none of this lump sum or dollar cost averaging takes away your responsibility of doing plenty of good due diligence on individual companies if that's the way you need to go. Another thing to consider is, what about trading fees and brokerage fees? As we know, trading isn't free, and although there are free platforms like Robinhood in the US and of course free trade here in the UK or Trading 212 or some other platforms, Lots of the older traditional platforms do charge per trade. You're going to have to think about those trading fees. What about those FX fees and those exchange fees? If you are going to be dollar cost averaging, all of those little fees add up and ultimately will cost you money in the long run. So the real winner for me is the one that works for you. You need to find the right way for you. And the great thing about investing is there is no right way. There are some great tips you can provide. There's some great ways of doing things. There's some great things we can learn from the past, but this really needs to come down to you and your own risk tolerance. How happy are you going to be? How well are you going to sleep at night, knowing your money's going to be in the stock market? How you do that is completely up to you. But of course, we want to make sure it's over as long a period as possible, because we know that gives us the best chance of a long-term growth and then finally maybe having that financial freedom one day. And then, touch wood, we should be on the right path. Okay, it's just some final thoughts now. So we always know that it's better to be invested than not. If we can learn anything from history, having loads of money on the sidelines, while it sounds great, it's much better just to be invested in the market most of the time. And then also on the side, having that emergency fund ready so you don't have to dip into your investments when life's emergencies come up. Remember, as we said many times before, nobody knows what's going to happen in the market. You can predict crashes all you like. If you go back every single year through history, you'll find someone who will predict a market crash in that following week or that following month. And guess what? It doesn't happen. It doesn't happen on time. We know the market crashes on average every few years, but we don't know when it's going to be or how that's going to happen or what's going to cause it. Just look at 2020, for example. Some more important things to consider than just lump sum or dollar cost averaging is just making sure you've got a well-diversified portfolio. There's no good lump summing or dollar cost averaging into your favorite YOLO or meme stock, hoping it's going to go up just because you dollar cost average into it. It's much better for your risk profile to have a diversified portfolio to know that you can weather those storms when the market is having a downturn. Just basic things like being consistent over time, making sure you invest no matter what the economic climate says and no matter what the news says is far more important than necessarily worrying about whether you should lump sum or dollar cost average. Just making sure that you're in the market is probably the most important thing, and making sure that you get an investment portfolio which is right for you. And if you do end up switching off all of the financial news and all the other things, you're still welcome back to my YouTube channel. Anyway, thanks so much for sticking to the end. I really hope you've enjoyed the video. Drop me a like if you have, subscribe for more, and I'll see you guys in the next one.